want you to understand the difference between internal audit and external audit. Right. So here's the company. Here's the company. Right? This is my company. In the company, there's directors, right? And there is shareholders. Directors is the management. Shareholders is the owners. Now, if I listen to directors, there's two types of directors. There's executive and non-executive. Okay. So, executive is the directors who works in the company day by day. They are part of the daily management. And they earn a salary, a normal salary. Non-executive directors are usually people who would sit on the board of directors. So the executive and the non-executive would have meetings, which is not part of the daily operations, but they'll have meetings to make important decisions, like in which direction is the company going to move? Are we going to issue more shares? Are we going to make another loan? Are we going to add another department? Stuff like that. So your non-executive directors are people who do not work in the company. They don't earn a salary in the company. They earn a salary in their job, which isn't part of the company, right? But they might be there because they are good in certain areas, and we have them there for advice. So it might be maybe lawyers. And most of the time also who would be there is people who own a lot of shares. So people who are close to majority shareholding or even the majority shareholder would be part of this committee. Right. Now these people do not get a salary from the company, but they earn, all these directors, the executive and the non-executive, they earn directors' fees. So directors' fees is usually a once-off in the year, but it can be more than once off. But it's sort of like a thank you for serving on the board. Right. And you will see when we do company financial statements that the directors' fees is a separate expense. Okay, why is it separate? Because of materiality, the GAR principle materiality, because it's material for the shareholders to know how much do we pay this directors for sitting on the board, because it's not a fixed amount. This amount is usually based on the company's performance. Okay, so it's usually alongside that. So just for interest sake, and I'm going to not record this because you might want. So now, next thing is also, this is for transparency. Now when we do now we're going to do good corporate governance. I somewhere abbreviated like that, GCG. One of the principles is we are transparent. We tell our shareholders how much we pay our directors because it's based upon certain things. If we don't do that, then what they do is they put it inside salary and wages. Now they're most hiding how much the directors earn for sitting on the board. Can you see? That means they are not transparent, and most probably they are avoiding scrutiny from the shareholders. Also, they need to show it separate, because they're not going to pay pay as you earn on this, because it's not a salary. But they will be taxed on it. When you do your personal tax, he has to declare it, as additional income. And he will be taxed at least 40, 43, 45% on that. Ne? Okay, because it's an extra income, it's additional to his monthly salaries. Okay, that's just interest rate. Now we've done directors. The other new expense that you're going to do is a thing they call auditor's fees. So now you need to understand, this is the company. Inside the company, there is an auditor. And this auditor works for the company. This is an internal auditor. Okay. An internal auditor works for the company. He earns a salary paid by the company. He's a normal employee. Right. An internal auditor is someone who studied a BCom, a commercial degree. Right? What does an internal auditor do? Now, if you think of any business, what assets do we have? We have debtors, we have cash, we have fixed assets, and we've got trading stock. That is our main assets. Now, those assets need to be kept safe. Ne? Now we have procedures to keep those assets safe. How do we keep our cash safe? Oh, we do regular bank recons. Ne? That's an internal control measure. Who's in charge of seeing that that internal control measure is being done? The internal auditor. An auditor is a checker. He checks. Fixed assets. What is one of the main basic things for land and buildings, vehicles, equipment that needs to be done on a certain regular basis? You said it. Maintenance. Maintenance needs to be done. We have to keep it working. We don't wait for it to break and then we fix it. Right? So now, maintenance needs to be done. Who checks that it's done? I had a friend who was an internal auditor at a mine. He had to release funds. In other words, he had to go down in the mine. If they are opening a new mine, now they're more growing, ne? They are digging further. And it costs money because now the machines that's digging needs to go deeper in. Now the funds need to be released for that whole process. So what he actually did is that he had to go into the mine, see how far they were and if they need to go further at this stage. He had to analyze the financial part of, is it viable to go further? Is it safe to go further? You see? And that's what the internal auditor does. Can you see he works for the company? So his definition is, he needs to see that there is internal control procedures to keep the company's assets safe. That's his job. Can you see that a big company most probably have more than one internal auditor? You'll most probably have departments. A department for the debtors, where the internal auditor is in charge, a department for the cash, a department for the fixed assets, a department for stock. You can even go smaller, a department for machinery, a department for computers. Then you can maybe have an internal auditor that's in charge of them. And he needs to report to the CFO, the Chief Financial Officer. You get what I'm saying? Okay. But now we also learn about an external auditor. So an external auditor is what you want to study for if you go study BCom Accounting Sciences and you want to write the word CA, Chartered Accountant, behind your name. And it's got the same status as writing the word doctor in front of your name. Ne? This is a very, very difficult course, and it takes blood and sweat. So the internal auditor only needs a BCom degree. That's 3 years. The bigger the company, the more prestigious, maybe you need to do your honors or your M or specialize in it. Okay, but any BCom degree. This, you need to get your BCom accounting sciences. Ne? And some universities makes a difference. They will say BCom accounting sciences CA route. Ne? This is 3 years. Then you need to get your honors. They call it something like the CTI or CTS or CSI or something. So you have to do your honors. Now your honors is usually 1 year full-time or 2 years part-time. Why part-time? Because you also need to do 4 years practical at an institution like either an auditing firm or a financial institution, or you can even these days they also allow you to do it at the JSE. So if you want to specialize in investments, you work for Old Mutual. You go 4 years to Old Mutual, you go to Investec, you go to the JSE. If you want to go into auditing, and let me tell you, this is very important. If you have 70 for maths, because that's what you need to go study BCom accounting, 70 for maths, and I think it's an APS of 35, and you need English 60%. Can you see the word accounting is missing? You don't need accounting to go study this, but you can see that it's going to be difficult to study your first year without school knowledge. Okay, but let's go on. Let's go on. This, you have to remember when you are doing a job, the jobs with the high salaries is the jobs with the high sacrifices. This is not something that everybody on the street can attain. It's something that's going to cause you for blood and sweat and a lot of tears. That is why they earn the bucks. And now let me tell you, if you go into auditing, so a lot of people say it's really boring because you check. But the fact is, you learn every process that's going on in the business. You learn about everything. And that is why you will see that most companies, if you go Google companies, remember, public companies must be public knowledge. Ne? So you have access to their reports. Then go look on those reports at the board of directors, and you will see that most of the CFOs, the chief financial officers, most of them are CAs. Because they've got a very strong foundation of what happens in the finances of a business. Okay. So, this is how you become an external auditor. Now, an external auditor works for an auditing firm. Can you see it doesn't work for the company? It works for an auditing firm. Right? They pay this guy a salary because he works for them and he needs food. So every month he gets a normal salary. Okay? He gets bonuses. That friend of mine that worked at the mines, he used to work at PwC as an external auditor. It's one of the most cleverest people I ever knew. I taught him in 2000. It's sad. He died of cancer last year when he was 40. But that guy started with PwC And his first, I think his first or his second year, his bonus was 150,000. Because that, your bonus, is based on the money you bring into the company. Not the company, the partnership. Because auditing firms are partnerships, they're not companies. Can you see their books does not have to be audited externally. It's only companies. So now, this auditing firm, like PwC, KPMG, Ernst & Young, and you also get smaller ones, okay? They pay a salary. Okay, so what is auditing fees then? Audit fees in my books. Why do I have audit fees? Oh, let's see the process. The process works like this. The shareholders appoints an auditing firm. Ne? So they appoint KPMG to come and do, because according to the company law, the books of the company has to be externally audited once a year. And if you go look at their statements, at their reports, there is in the reports a report from the external auditor. Okay. So, I will talk more about that. I just want to tell you now. So now the shareholders are the ones who appoint them. So you will see that that report is to the shareholders. It's not to the company. Because remember, the shareholders can't go in and check the books on a daily basis. They only see the books once it's published. And they want to make sure that the books are done according to IFRS, International Financial Recording Standards. Why do we want to use IFRS? We want our books to be international. Did you know that if you study accounting in South Africa, you can go work anywhere in the world, because the accounting systems that we teach you is according to IFRS. This is how Australia do their books. This is how America do their books. This is how Hong Kong does their books. You get what I'm saying? Okay. So we want to see that our books is done according to international standards. Why? Because if you have an investor, the investor wants to be able to take your books and compare it to another company's books, because they are set up on the same standards. But we can even go further than that. I want to be able to compare the company in South Africa with the company in Switzerland and know that their books are on the same standard. And now I can decide, am I going to invest here or am I going to invest here? Okay, so that's why we do that. We also want to see if it follows the company law. The company law, I remember when I studied 1989, I was second year, and second year auditing, you had to study the company law. It was a book, pages like this, A4 pages, in a file like this. You had to know it off by heart. Can you please switch off your phone? You had to know these pages off by heart, because when you go and you audit, you need to be able to see if the books is done according to law. And for instance, in that company law, it states that a company must make a minimum of 2 provisional payments. That's in the company law. So now if I as an auditor go in, I'm going to check, did they do 2 payments this year? You see? Okay. Another thing they have to take into account is the GAAP principles. Now, interestingly enough, the GAAP principles isn't international. There's a lot of GAAP principles, but every country has different ones. So it might be that we have 5 that's the same as America, but they've got 2 others that are different. Okay. So this external auditor goes in to do that, and he reports back to the shareholders. But do the shareholders pay them? Why? Quickly think about this. Why do the shareholders send in the external auditor? To see that the books are above board. Right. Can the shareholders, now, the team that the auditing firm sent into my company to audit the books, né? Because they have a team that they send in. So they go in, they audit the books. Now can you see that team that goes in, that team of CAs, né? Internal auditors. Can you see that the shareholders can't have any contact with them? Can you see that the company must also not have contact with them? Why? Because this CA team, this external auditor team, has to not be biased. Can you see, if they have contact with the shareholders can put money for them, they can bribe them. Why? Why would the shareholders want to bribe them? Because an audit report can make or break a company. And remember, if you have money in that company, you want the share price to stay high. It's your interest. So you don't want a bad report. That's not what you want. So you want to keep them away from each other. After the audit, they write a report addressing the shareholders. But it doesn't mean that all the shareholders comes together and now he's going to talk to them. Ne? There has to be a separation. Same with, he is separated from the company, meaning an external auditor, and please guys listen, an external auditor is supposed to be totally 100% objective, meaning he may not have shares in that company, he may not know anyone close to him working in the company, because that's going to influence his bias. You get what his objectivity. You get what I'm saying? If my auditing firm sends me in to go audit UPSA here in the city, but my wife is the is a cashier there, ne? Or she is a manager there. Can you see that that guy that they sent in is now biased? So if he sees something's wrong with that company, he might decide not to report it, because if he reports it, it might be that the boss at that company gets angry because he reported it and fires his wife. You hear what I'm saying? Or if I have shares in the company and I go in, and now I see, oh, this company is bringing out a new product next year, and this product is going to be a killer, it's going to be so cool. And then you go and you buy shares because you know the share price is going to climb. Can you see that is insider trading? Because you are operating on information that's not available to the public. So now what happens? Now your boss calls you in, he says, listen, you are part of the team, I want you to be the team leader, because you are my kid, so you are going to be leaders. You are the team leader of the 4 people who's going in to audit UPSA in CBD Pretoria. Then it is your obligation to say, sir, I am just telling you this, my sister's daughter works there. Now you have told him that. Can you see, now you are transparent. Now it's your boss's decision. He can say, oh no, I trust your integrity, go. But you say, no sir, I'm not comfortable with that, I would rather not go. Then he needs to choose someone else. Or he says, no, it's good you told me, I'm going to take you off, I'm rather going to send you to Sabi to go and do some or other lodge there. You see. And can you see now, an external auditor works for this auditing firm, but he travels a lot between businesses. So it could be that this auditing firm only audits Pretoria companies. So then you're going to be one day in this place for a week, and then next week you're there for a week, and next week, but it's all in Pretoria. But a lot of, if you work for big auditing firms like PwC, you might be a week in Sabi, 2 weeks in the Cape, 3 weeks in Japan, 7 weeks in. So can you see? Very nice if you're not married. Next. And you love traveling. Very bad if you have small kids. So can you see a lot of your job is in the end going to depend on your life that you want to live. And is the quality life going to be, you want a lot of money and it's all about success and growing in the business? Or is the kind of life where you want quality, your family? So you're going to, but then once again, being able to write CA behind your name is like having maths. It opens more doors. You can choose to become an internal auditor. Remember that guy I told you about? He was a CA at PwC. He decided the hours were too bad because he worked in the morning 6 o'clock till 8 o'clock in the evenings. I had a friend, I still have a friend. This friend of mine is also a CA, but he's currently a CFO at a mining company. He, 6 o'clock, he gets his driver to drive him to Joburg. Why does he get a driver? Because in the car he sits and works. And remember, the traffic is bad. It's an hour and a half drive. So he sits in the car and works. 8 o'clock, his driver drops him again in the evening. Then only does he go home. What family life does he have? Okay? But it's his choice. It's his choice to work like this because there's a lot of doors open for him because he's got that degree. You see? It's all about your choices. Always remember, money. The more sacrifice. The more blood, sweat, tears. Okay? So, enough about that. So now, what is auditing fees? Auditing fees is what the company pays the auditing firm. The company pays the audit fee to the auditing firm. The auditing firm pays the CAs, the auditors, the external auditors, their monthly salary. You get that? I've talked a lot because I'm trying to make this appealing to you, that you understand what the world is about in companies. Is there any questions before I go on?